Long-term interest rates recently logged highs not seen since June. What's driving the move? Hi, I'm Griffin of Derivative Logic, here to get you straight to smart. Even though long-term interest rates have eased off their recent run of highs, many in markets are still scratching their heads as to what's behind it all. Let's take a look. In short, fixed income markets are now pricing in 1. Less stimulus support from the Fed going forward, as it's now broadly seen that the Fed will likely taper by year's end. 2. The risk of even higher inflation sparked by an economy that's slowly improving amid fewer COVID-19 cases and growing vaccine mandates. 3. A growing sense that other central banks around the world are underestimating the risk of inflation as supply bottlenecks worsen and a broadening energy crunch in China and Europe begins to push prices for goods and services higher. And finally, 4. The solidifying stalemate over President Biden's economic agenda. Given that none of those drivers are seen as evaporating anytime soon, it's a recipe for long-term yields to hang on to most of their recent gains and slowly expand upon them through the end of the year as global investors' appetite for risk scales back amid a new supply-demand dynamic and continued, albeit uneven, economic growth. As such, we're expecting the 10-year Treasury yield to finish the year somewhere between, say, 1.6 and 2% and linger there until the Fed stages its first post-pandemic rate hike in late 2022 or early 23. For the week ahead, with all signals pointing to the labor shortage as being the major driver behind higher prices for businesses and consumers, and therefore slower economic growth, this week's September jobs report, released on Friday, will be front and center. Believe us, the Fed will be scouring this jobs report. Why? In its last policy meeting in September, Fed Chair Powell and company implied that they're all but certain to announce a taper plan in November, assuming progress toward their price stability and full employment mandates are being met. What's the one measure of progress needed to give the Fed a green light to taper that's falling short? You guessed it, substantial progress in the jobs market. Since this Friday's jobs report will be the last set of labor data that the Fed will get before its November meeting, it will be the decisive data point to seal the taper deal. That being said, the bar for derailing the announce in November, taper in December Fed schedule is high. The jobs report would need to be a massive disappointment, say showing that less than 300,000 in new jobs or so were created, for the Fed to feel the jobs market improvement is falling short of its substantial progress requirement. From all of us at Derivative Logic, have a great week.